G'day folks, and welcome to your Checkonchain update for the 16th of May, and we're going to be talking about stair-stepping to price discovery. I'm going to call it supply discovery because we're not technically at price discovery yet, which is when we're above all-time highs, trying to work out what the new equilibrium price is. But we have broken through a very important level, which you can start to see on this particular chart, which we'll cover shortly. We've got above the largest volume node. Now, if we look at all of the supply that's moving around on chain and we price it at the time when it last moved, there's basically no top buyers left. We have broken through the area where key resistance should have come in. We're obviously chopping around sideways at the moment, but in a very, very stable and what I'm going to call quiet and trending bull market. So we'll talk through all of those dynamics, and that's really what today is going to be about, setting the backdrop for really looking ahead. We're going to make a bit of an assumption that the market does want to go higher. It certainly seems to be the case. So I'll build up a bit of an evidence base for that. But really what we're going to be talking about today, how high can we go? So I think, look, at some point in time, you have to just accept that Bitcoin wants to go higher. And even if this report, let's imagine that this is a perfect report where I talk about how high I think Bitcoin's going to go. We're going to head to price discovery. And what I don't know is that the next 3 years is a horrendous bear market. So be it. At some point, Bitcoin's going to bust through this level and we are going to go to a new zone. So even if I'm dead wrong here and the market doesn't want to go higher and I'm an idiot, we're still going to be able to use these concepts and tools down the road. So we're going to talk about what I mean when I say supply discovery. It's kind of like the precursor to price discovery. We're going to talk about long-term holder sell pressure because that's usually going to be the fly in the ointment when long-term holders decide, no, not today, and they start cashing out. So we want to make sure that they're not going to give us a bunch of grief. And then we're going to look at topping models and really trying to how I think about and project forward, like what is a topping model? How do I define them? Why do I use the metrics that I do? And most importantly, and we'll talk about when we get there, having a plan before it happens. Full well knowing that none of us can predict the future. We just don't know what the market wants to do. We have no idea what kind of headline's going to come out. Markets are just information, and the only thing that we can do is control our decision. So don't so much think about it. I certainly don't. I don't think about it as the price is going to go to 120 or 160 or 180K. I think about it as what am I going to do if the price goes to 120K, if it goes to 150K. All I can control is the decisions that I will make between here and there and when we get there. And if there's one piece of advice I can give absolutely everybody watching this, having a plan right now before the market starts moving is a hell of a lot easier than when it's moving trying to formulate a plan. Because our greedy ass brains will go, oh, but what if it goes to 200? And of course, the moment that you have that thought, that is the exact moment when your plan would have said, hey, you probably should make a decision at this point in time. Make those decisions now, have them written down, make that plan before we start accelerating, because once it starts moving, your rational brain, it is so over for thinking clearly. Once this thing starts moving, have a plan, write it down, stick to it, and really that's the best advice I can give you. Let's get stuck into the charts and see how far we can go. Okay, so when I started writing this piece, I realized that probably a nice way to talk about the current market structure was quiet and trending. And strangely enough, I wrote a piece called Quiet and Trending, which you'll find linked in the intro. And strangely enough, I wrote that the 16th of May today. I wrote that piece on the 14th of May last year, very early on in the Checkonchain experience. So, it's kind of a bit poetic that we're talking about almost the same market, but like here is the price chart since 2023. And this concept that I use of quiet and trending, I actually borrowed it, or I use it from Doc Sevison, who really taught me almost everything I know about technical analysis and market structure and options and all those things. That's where I learned a lot. I really found my spark for why markets were so fascinating. And he introduced me to this concept of, it's like a quadrant. Where are you in the volatility regime? It's either quiet, where it's not very volatile, or it's really rock and roll, or it's going sideways in a trend, or it is rallying or selling off, moving in some direction. Is it trending? Is it going sideways? Is it volatile, or is it not? And you can look at all those in different combinations to get a bit of a read for where the market is. So if we just look at the Bitcoin price chart on a monthly basis, and again, we're just going to focus on them, and the fact that we're just grinding up in this channel is pretty cool. Quiet and trending is up, sideways, up, sideways, up, sideways. So on a monthly basis, this is a quiet and trending bull market. This is an extremely stable market structure. This is exactly what you want to see for a healthy, robust, consistent bid. Absolutely beautiful. Love to see it. Let's look at it on a weekly basis. Now, obviously, within the weekly basis, there's going like every single monthly uptrend is made of lots of weekly uptrends and downtrends. There's like little bull markets and bear markets the whole way. But even on this front, up, sideways, up, sideways, up, sideways, up, sideways, right? You kind of get the picture. And then if we zoom in on the daily, right? This is up, sideways, up, sideways, up, sideways. And these little consolidation ranges are so good because they're high and tight. It goes up and it just goes perfectly sideways. There's something about this particular market regime from 2023 onwards where we're just getting more and more of this. I don't know if this is like institutional or whatever it is, it doesn't really matter. The market is trading in an extremely stable, healthy, like it's just really hard for me to paint a bear case when the market is doing this type of price action. It is exactly what we want to see. Now, at some point in time, this quiet and trending maneuver, let's go back to the weekly, I think. At some point in time, we're probably going to get something like this, where it just goes completely and utterly unsustainably vertical. You can actually see the difference of how structured this up sideways price action is in our current cycle compared to 2021. We just went absolute lift off, and then we had this volatile and sideways, this was really, really nasty, and we had a bear market that came off the other side of it. You could argue 2017 was a bit, we even had sharper pullbacks, but the pullbacks didn't last as long. This is just a very, very structured bull market in my view. Really healthy stuff. I'm still trading within this channel. I really couldn't ask for a better looking uptrend if I tried. Okay, so what I want to talk about is supply discovery. So this is kind of it's one of my just terminologies to help us understand things, but really it's about this precursor to getting into into price discovery. So there's a point in time in every correction where you just break through this level where all those investors who were underwater just 2 weeks ago, they're going, sigh of relief, breathe out, okay, feels much better now. I'm no longer staring at this nasty red number. I'm feeling pretty good about my decisions. Now, depending on how long you've been in this market, this is like an on-chain volume-weighted cost basis. So for ease of numbers here, imagine you're a DCA hodler. You got in 2016 and you've just been stacking ever since. Your cost basis, I would wager, is probably somewhere around 18, 19K. Let's just group these all up. Let's call 2016, 17, all the way to 2019. That's kind of one class. 18K all the way up to 31K. So that's really, it's trying to paint a picture that if you've been around for 2 cycles, your average cost basis is probably down near the bottom of our previous cycle. 20K, 18K, 30K, that's most likely where your cost basis is going to be. If you're from 2016, you're probably on the lower bound. If you're like me, where I bought in 2017, worked it out in 2019, right? So I'm kind of somewhere in the middle. My cost basis is somewhere in here overall. Now, if you got in the last cycle, 2020, 21, 22, your cost basis is somewhere around 36 to 42K. Now, why is that zone important? 36 to 42 is pretty much where the ETFs went live. And for all manner of reasons, I think it's improbable that folks from the last cycle, if this is your average cost basis, and certainly folks from 2 cycles ago, I would be amazed if price ever comes back down to visit these cost bases. I think we've done away with those levels. We're now a $1 trillion asset, and I think the momentum is probably to the upside. So this is one of those things, it reminds you that if you stick around Bitcoin long enough, at some point, your cost basis will never be revisited again, and you will forever be in an unrealized profit. It's a pretty cool concept, really. Now, let's look at 23, 24, 25, the red zones. Because these are obviously people who've come in during our current market rally. Now, if you've been around since 2023, right, 54K. If you've been around since 2024, maybe the ETFs were that thing that got you involved in Bitcoin. Your cost basis most likely it's probably been tested a couple of times, and it was probably a little bit spooky. Depending on how much you bought up in this zone, there may have been periods of time where you've been tested, right? 72K is not too far away from where we dipped down to very recently. And I can only imagine that you're feeling a bit of relief now that we've got this rally. You've gone back into an unrealized profit. All those scary ass buy the dip moments are feeling much better at the moment. And even folks who started stacking in 2025, 92K, that's approximately where the short-term cost basis is. I think it's 94. You give this thing enough time, and eventually you'll be one of these classes where the price will just never go back down to your cost basis. But the reason I wanted to highlight this, markets are a confidence machine. And folks down here, after 2 cycles, you stop thinking about your cost basis. It actually ceases to be a part of your, I actually couldn't tell you what my cost basis is. I just know it's somewhere in between those lines. I don't actually know what the number actually is, 25 or 20 or something. I don't really know where my cost basis actually is because I just don't think about it. However, folks who are up here in this red zone, you've been in here for this cycle, you're probably a lot more aware of your cost basis because you haven't had that moment of liftoff. Don't worry, it will come eventually. But it's interesting because when we see these zones, it's like a confidence. I'm pretty sure, I'm fairly confident that we won't get back down to the ETF zone because we, have to undo the ETFs to really get down there, or something really nasty has to happen. And I would say that all of these folks would very happily, if you see that price again, you're going to step in and buy your cost basis. So I think the gravity is probably to the upside for a lot of these folks, and we've really just been testing the recent buys as of late. Now, when we talk about supply discovery, we're talking about 5.2%. In fact, not even. What is this? 4.7% of the Bitcoin supply is currently held in an unrealized loss. Everyone else is sitting pretty. So there's, we should have found a stack of resistance in this zone, and we just didn't. Another thing to note is about 9% of the Bitcoin supply. I think back in December, price was like 100K. We started talking about what is now the infamous air pocket, where we had very, very few coins transact between 75 and 86. Now we've got about 9% of the supply that's moved down there. Speaking of this confidence machine, we just didn't know how much demand was down here. The market went there, tested it, and the bulls said, thank you very much, back up we go. And we're now above the largest supply cluster. So overall, the market is really saying, look, I liked it at 100K. I liked it also at 85. I want to see what comes next. Show me the next chapter of this movie. And the bulls appear to be in control. So this is, honestly, really, really good to see. I think a lot of the hard work of this rally is done, getting through this zone. So this is really where we expected a lot of resistance, and we just haven't seemed to get it, which is a thumbs up. Now, if I rotate that, let me just snapshot here. This URPD, so we call it a URPD. This profile is showing you where the cost basis of all the coins are versus price. Let's rotate that onto the right-hand side of this chart, except now we're going to plot it in USD. So that was in BTC terms. Now we're looking at it in USD. And the reason why I like to do this is it's telling us where do people invest their money. So it's pricing every coin at the price when it was last moved. So you can see down the bottom here, really, historical prices just don't matter on a USD basis. All that matters is the last 2 major supply zones. So, and as you can see, we've popped our head above this giant USD supply cluster. This is what I mean about supply discovery. We've now broken through that area that we should have been the majority of the resistance. We're above the short-term holder cost basis, the 200 days on a nice strong uptrend. True market mean is starting to inflect higher, as is realized price. Let me turn this one off and I'll turn on unrealized profit and loss. So we can look at things in all sorts of different metrics, and you'll see me do it in supply terms, USD terms, but this one here, we're going to look at it in unrealized profit or loss. So remember, if you buy a coin at 50K and the price goes to 100K, you're going to be up $50,000 times your coin volume. That's what we're looking at. Now, see this tiny little negative nodule over here that you got to squint to see? That's all the unrealized losses that remain. You can basically discount them. We're in supply discovery. We're at this point where every single hodler, of these coins, I would say the large majority of them, no one just bought the top and that's it. Every single hodler who is out there, who is still in this market, you'd be hard pressed finding someone who's actually underwater because they must have bought some other coins lower. If you didn't, congratulations, it's quite the achievement. Somebody out there might be it, but most people are going to be in an unrealized profit. So let's keep with this theme that markets are a confidence machine. where did we last have a significant confidence that we belong here? And the bull said, no way, go higher. It was the 2024 chop solidation range. You could argue that we're currently forming another one of those. So you can see this volume note at the moment. The reason why this is red is it's short-term holders. We're in the process of battling out to say, do we belong up here? We really proved, and the long-term holders who are still down here, we proved that we belong here. And the true market mean, which in my view is like this is what I'm going to be using for the bear market floor. In fact, all of these models are relevant for understanding market cycles. Again, think about it from a level of confidence. The true market mean is where we prove we belong there. And you can see it's 67K. It's right at the top of this last zone. We belong above this level. If we go down to that level, you know, this was it when we talk about the air pocket. This was the zone where it's like sell the shares, sell everything. You know, it's deep value at that point in time. The short-term cost basis is kind of that we haven't quite formed it yet, but it's at the closest that we've got. In our current price action, we've got a pretty decent amount of confidence at 94K is where the market wants to be. We traded below it, and now we're firmly back above it. I expect it to be a resistance. 200-day moving average is coming up. All of these things, technical, on-chain, there's a good reason this should be support if we do pull back. And the true market mean is starting to move. Let's just envision Bitcoin goes on a run to 150K. By the time it gets there, I would wager that the true market mean has probably climbed up and is probably somewhere up in this current range where we are, the last place that we formed confidence. Now, the realized price, that's down here with the, was it class of 2020, I think, 2022? It's down here at the ETF level, 40,000, 45,000. So this is really the two levels back where we formed confidence. So these models are really telling us where we are in the grand scheme of things. We're above the short-term cost basis. As a simple rule, we're allowed to be bullish when we're above the short-term cost basis. When we break it below, then we can start thinking a little bit more cautiously. But if we're above, I allow myself to be bullish because that's when it is going higher, right? The market wants to go higher as long as we're above that level because that is where we have near-term confidence. The market has bought enough coins at that zone. They're saying there is a demand floor here. Can it break? Yes, it's the first one to always break. We did break it and we recovered it. So far, so good. Looks good to me. So I suspect these will start trending up and they'll move up to that next level. And then we're just kind of stair-stepping our way higher. Love to see it. Now, there's three questions that I want to answer. So we're allowing ourselves to be bulls at the moment, assuming that we're going to go from supply discovery into price discovery. We've got enough tailwinds behind us. There's three questions that we need to answer. How far into this sports terminology, how far into the game are we? How many quarters or innings are we in? Are long-term holders selling, which is going to be the fly in the ointment where they say, well, actually, no, I'm going to cap this bull market right here and now. And the last one is how high can we go? So they're the three questions we're going to go through. Let's start with the first one. The framework I'm going to use here, we'll be using quite a bit as we move, assuming that we move higher, we're going to be using this framework quite a bit. And the idea is just, it's simple statistics, trying to work out how likely is it that we keep going higher. So NUPL stands for net unrealized profit and loss. It is MVRV just displayed slightly differently. Whereas MVRV shows us the unrealized profit or loss multiple, paper gains in the market, NUPL shows us the exact same information, but as a percentage of the market cap. So where we are at the moment at 0.56, that means that if you take the Bitcoin market cap, which is $2 trillion, 56% of that is unrealized gain, right? That is $1.12 trillion. Bitcoiners are sitting on $1.12 trillion of unrealized profit. What an insane number. Now, granted, that includes Satoshi and it includes everyone else. If we actually wanted to calculate, and I do have one on the charting suite, if we want to calculate excluding lost coins and excluding Satoshi and all those folks, that's where you would look at the true market mean rather than the realized price. We do have a true market mean NUPL. But let's not complicate things. Let's just eyeball where we are at the moment. At 0.56, we're kind of right in the guts of, we can see in 2017, we hit it twice, and then we started to get really euphoric. It's pretty much where we were in November 2020, so right before we started to inflect higher. And it's below the peaks that we set in March and November last year. So just eyeballing it, you'd say, okay, we're certainly at the upper bound of the bull market, but we're nowhere near the extremes. Things can keep going. 2019, we were actually higher. So, it's exciting, but it's not full-blown euphoric. So eyeballing, that would be like a gut feel. You'd probably say maybe we're in like the last quarter, maybe, of the sports match. And that's where we can bring in statistics. And if you can believe it, we're pretty much dead on kicking off on the fourth quarter, right? So if we look at where NUPL has traded, so this histogram is basically showing us like a population of every single day, where has NUPL closed. And you can see that we're only just getting over this peak. And if we look at how many days are lower than where we currently are, it's about 75. That means that 25% of the time is above. And remember, the 25% of the time where it's above, that is usually the most exciting phase of the bull. That's where things are really starting to rip roar to the upside. So it's also where people get the most excited. And why are we looking at NUPL in the first place? Well, a high NUPL or a high MVRV tells us that the average Bitcoiner is sitting on really, really fat gains. When the average Bitcoiner is sitting on really fat gains, what are they likely to do? They're going to start selling and distributing into the market. So the reason why we look at this is we're saying, like, how green can it go? It's like beat the bomb, where you've got to sit there and wait. You don't want to wait too long, because eventually the bomb goes off and you lose all the money. But at some point, hodlers are going to start selling. Right now, it would tell us we're kicking off the fourth quarter, and that fourth quarter, that's where all the excitement goes, right? That's where the goals start to get kicked, and it's where things really start to change and inflect to the upside. So let's hope. Now, that's looking at it from an on-chain perspective. Let's also bring in a technical model. There is nothing better than the Mayer multiple when it comes to technical analysis of Bitcoin. It's just such a tremendous model. How far is Bitcoin away from the 200-day? It seems so simple. It is so simple, and that's why it works. I love using it. If there's like a metric that you want to give a normie friend who's just getting into it, give them the Mayer multiple and just say, buy whenever it's low, don't buy when it's high. Sometimes it's just that simple. Now, we have pulled back to pretty much zero. So we're looking at this on a Z-score basis. And the reason we do that is we're trying to look at how far away from the mean are we, because Bitcoin actually usually trades above its 200-day moving average, not by much, but by almost exactly the amount that we currently are. 103K versus 92K. That delta is pretty much where Mayer multiple likes to be. Dead center. No froth, there's no momentum, there's no, all things being considered, if we're going to eyeball this in, it's hard for me to say that we're overheated at this point in time. In fact, the best possible description I can give you of where we are right now, based on this metric, dead center fair value, where Bitcoin belongs, where it should be, based on where the 200-day moving average is trading. And much like many of our metrics, it seems to be oscillating around this level. So we've gone from a period of overheated to underheated, back to fair value, overheated, underheated, right? We'll see how this plays out. So that was eyeballing it, and you're saying, there's not really that much froth. If we look at it on a histogram basis, as a percent, 40% of all days, the Mayer multiple is actually lower. 60% of the time it wants to go higher in a bull market. Now, I get this question quite a bit when I show these histograms. I do have the possibility you can look at what this would look like in a bear market. And I have these lines in here so you can assess, right? Do you think we're in a bull? Do you think we're just in a normal market and you don't care? Use the orange ones. If you think we're in a bear, you can compare those. The idea is to take a view and say, well, what are my probabilities in any one particular scenario? So in a bull market, and I've literally manually defined this and said this was a bull between this point and this point, and between here and here was a bear. I've manually defined it. And then if you don't want any of that bias, just look at the total and say, well, where are we? On the total, dead center, right? 53%, half the time we're above, half the time we're below. There's no gravity in either direction. In bull markets, there's approximately a 60% chance we want to go higher. So gravity is actually to the upside. And bear market, who cares about the bears? Now, on the long-term supply selling, because this is the thing that's going to cap us out, right, and stop this market from moving higher, there's an important nuance about long-term holder supply. And I've mentioned it before, but I'll go over it again. Long-term holders are defined at the 155 days. Statistics, it's based on when coins go dormant. They usually stay dormant. Coins older than 5 months. I know a lot of people on Twitter hate it when I say they're long-term holders. Doesn't matter. Statistics are more important than opinions. The statistics say that once a coin is 5 months old it's got a very similar probability to a coin that's a year old or 2 years old or 3 years old of being spent that day, and it's not very much. Most of the coins that move every day are younger than 5 months. That's really the important takeaway here. So it's a very clean delineation. Many analysts have verified it. It's honestly, for our purposes, it's good enough. Now, the nuance I want to flag, you'll see this on Twitter. I guarantee you at some point in the next couple of weeks, you're going to see someone saying long-term holders are stacking sats once again. And granted, long-term supply is absolutely ripping. It's up 1.2 million Bitcoin in the last month and a bit. So yes, long-term supply is ripping, but they are not buying today. This metric does not model people who are buying today. The nuance of this metric, in order for it to go down, it just means that people are spending more than they're hodling. More coins are leaving long-term holder supply than are migrating across that 5-month boundary. The flip side is it takes 5 months from a coin to be bought and then to migrate into this bucket. So it's actually telling us when this is moving higher, it's telling us two things. The people who bought up here, you can see where the blue price, long-term versus short-term, the people who bought on that threshold, they are hodling, and then the rest of the long-term holders are also hodling. So it's telling us that the people who bought 5 months ago, 1.2 million Bitcoin remain held from 5 months ago, and the people who are already long-term holders are not spending. So that's what it means when it's going up. Overall, it's we've talked about the lead foot, the accelerator of demand, and we've got the brakes of long-term holders selling. When this is going higher, it means the brakes have been taken off. People have stopped selling, they're backing off, and therefore, if the demand stays the same or accelerates, in theory, the market's going to want to move higher. So you will almost guaranteed see people starting to talk about long-term holders are stacking sats. They're not. They may be, but that's not what this metric is showing. Because it's showing us people who bought 5 months ago hodling on, which also is it's still a good sign. Now we can verify that because as you can see, there's a couple of moving pieces that go into long-term supply. We can look at how much is actually being spent out of those cohorts. And right now it's about 13,000 Bitcoin a day, which by the way sounds kind of scary, but it's a far cry from 40,000 per day or 36 or 32. So it's substantially below, right? It's 3 times less than we see at market tops. And honestly, we always have old coins moving. It's just part of the system. Some of these are going to be spent, sold. Some of them are just moving between wallets. It doesn't really matter. Amongst all the background noise, what we don't want to see is this accelerating much, much higher. Right? If we start seeing this moving considerably higher, it starts to look more like a sell-side pressure. It tends to happen near tops. It's funny how that happens. Right now, I would consider this normal for a bull market. Looks good. Makes sense why long-term supply is increasing. And we can look at this from another perspective. This is looking at all long-term holder supply when it's spent. And we're looking at the rate of change. So in the orange, it's the dollar value of how much long-term supply is coming back to market. You can see it's clearly here's your sell-side peaks. This is what establishes a top. And then they just stop. And they really take their foot off. So in theory, the bulls have the best possible environment right now to push us above all-time high. Basically, long-term holders said, all right, let's go. I'm sitting on my hands. Let's get this party started and move this price above. I want to see the next chapter of this movie. I don't want it to go lower. I'm stopping my selling. Let's rock and roll. So long-term holders are sending the message. It now comes onto the bulls to actually step in and drive this thing higher. Now, it's not going to be the perfect metric. Measuring demand is actually quite challenging. It's not an easy process. The ETFs give us a pretty decent view on what's going on. This is one of the weaker, 233 million this week. It's one of the weaker weeks so far. We had a couple of multi-billion-dollar weeks. So, 230 million so far is certainly nothing to snuff at. It's still a pretty decent number in my view. But at the same time, it's not quite the same strength. So, generally speaking, we see ETFs like all demand. People love to follow once the market starts moving. So it's actually quite amazing that we're trading at 104K. Yeah, 104K. And it's just quiet. It's just humming along. So I would say we'll get new waves of demand, but we haven't got this kind of massive impulse just yet. I assume it will follow price if we do get a kick up to the next gear, but that's certainly one to watch for. Who knows? Maybe we get a correction and then the ETFs step in and people go, yep, that's it, slingshot. We'll have to just wait and see. But, we do have a bit of a softer demand profile in the near term, but I wouldn't put too much weight on that just yet. We'll see how it plays out for the rest of the week. Okay, here's the fun stuff. This is what most people want to know. Question 3, how high can we go? And I want to frame this up by why on earth did I construct all of these price models? We're going to go through 3 different price models. They all use the exact same concept. They're different ways of visualizing and viewing, but they all tell the same story. We have no idea where the top's going to be. We have no idea when the top's going to be. We don't know what the circumstances of that top's going to be. The only thing that I have a fairly confident amount of, a large amount of confidence in is that it's going to be formed when there's too many sellers than buyers. That's generally speaking what causes a bear market, too many sellers than buyers. So how do we know when those sellers are going to appear and arrive? Generally speaking, sellers show up because the big green number in their portfolio says, I'm big and green and I want you to buy some lifestyle chips. Smart money have a plan. I spoke about this at the start of the episode. Smart money know when to sell. And by the way, it doesn't mean you have to sell. I'm not, you do whatever you want to do. But there are going to be people out there, depending on where you are in your hodler's journey, who are going to take chips off the table. And I think the most important thing to recognize, like for me, I'm young enough to still be in accumulation mode. I probably won't sell any Bitcoin this cycle, to be perfectly honest. I'm just going to not buy the top. That's another way that you can just avoid financial pain is by just not buying the top, because I've done that 3 times now, and I won't do it again. Right? I did it in 2017 when I first got in. I did it in 2019 because I thought there was going to be no ceiling, and I bought not quite the top. I think I stopped at about 50K in 2021. That was the last time that I bought, and then we did top out. I'm pretty sure I would have bought some on that second high maybe. But anyway, I've done it 3 times now. It sucked every single time. I'm not doing it again. So having a plan that suits you and just thinking about it now is just the best thing you can do. Have the plan, write it down, and then execute it while your brain is not in full-scale euphoric mode. So just knowing that out there in the world, somebody will sell when their portfolio is too green, because they always do and they always will. Maybe this is the cycle where everyone just decides I'm never selling. I wouldn't bet on that, but maybe. If that happens, I'll reshape all my models and I'll find some new level. Now, until that point, let's just look at where MVRV needs to get to for those statistical levels. Where does the unrealized profit, that incentive to sell, where does it have to go before every single hodler in a similar condition has gone, all right, I'm going to start selling at this point? So from the short-term holders, when we look at short-term holder metrics, like the name says, this is short-term. This is like an interim peak. It may be the top, but they generally help set those more near-term, right? The first point where we have a correction, we probably bust above all-time high and then we pull back and retest the all-time high. There'll be a bunch of stuff like that. Now, the first level, 1 standard deviation for MVRV, short-term holders, 110K, fresh all-time highs. We'll see people start selling there for sure. We always do. But we also usually get demand start to really flow in. 1.5 standard deviations is 118K. And then 2 standard deviations is 126K. So if the market just explodes, I would wager we get up to 120 something, right? That's 118 to 126, somewhere in that zone. And then we'll have a gut check, something that pulls back. And I mean, maybe we just zip straight through it, but that's the first area where I would say it's likely we're going to get some near-term chop and maybe a correction. TBC, we'll see how that plays out. Now, zooming out to the whole market, so not looking at short-term MVRV, we're looking at just MVRV itself. Here I'm experimenting with these. Rather than looking at it as a Z-score across the whole history, the problem with looking at the whole history is, as we know, the Bitcoin cycles are evolving. So here I'm looking at it over a 2-year window. And the idea is that let's compare this bull market to itself, because we've been in this bull market since 2023. So really, we're comparing where is MVRV relative to this bull? How is it trading relative to itself? Now, we pulled outside this cloud, 75K, and then we bounced back into it. Good to see. We managed to climb back in. These bulls, we all tend to stay. Once we break out below, usually it gets a little bit hairy. So, we want to stay within that topping cloud. So looking at the whole market, 124Ks, we get to about 2 standard deviations, lines with that, lines with the short-term holders. 140, 160, that's where things start getting really overheated. You can see that we busted through there. And by the way, these are moving targets. I do actually have a piece, if you missed it, called Moving Target. The reason why these move is it's all based on demand. As more demand comes into the market, we can start to lift our confidence and lift our price models. This is really telling us that those average cost bases, as they climb, as new demand comes in, it's telling us that we have more confidence moving up in the ranks. Sometimes we overshoot and then we have to pull back. People realize losses. We have a bear market and things correct back down to those levels. So, it's all part of that process of trying to find equilibrium. But so far, in terms of bull market structure, it looks really, really good. And this is telling us, 160, 140, 120. What I want you to take away from these topping models is the consistency. You'll see that there's just particular zones. 120 will continue to show up. 150 will continue to show up. 160. These are areas where we're probably getting pretty long in the tooth, especially if we're in that last quarter. Now, this topping model chart brings all of those together. So we've got MVRV, we've got true market mean, we've got short-term holders. This bottom zone, this is what is called vaulted price that we designed in coin time economics. Again, these aren't predictions. They are areas where I expect investor behavior to change based on where it has previously changed. And when I say change, what does that mean? Right now, hodlers are hodling. They appear to be sitting on their hands doing nothing. I want to know when that's going to change. I want to know when they go, okay, now my portfolio is so green, I have to start selling. And I just want to have a plan for expecting that to be the behavior. I want to have my plan so I know exactly what I'm going to do when I look at these charts and I see long-term holders selling like crazy. I'm going to look at the price chart and go, but it's so green. Check the hodlers going, dude, buy as much as you can. And then check the analysts to go, don't do it, sir. Don't do it. You've done this before. And it's going to be a fight between those two. We've all been there. Check the analysts are going to be very objective and say, mate, you are so far above those levels. Stop. Put your wallet away. Sit tight. Enjoy it. It's going to be a part of the movie. So when we get to 120K, vaulted price, bottom of the short-term holder zone, this is where people are likely to start selling. I've actually had a conversation with a couple of guys who've been around for a long time, and they have also said 120 is where I'm going to start ramping up. So just anecdotally, data-wise, that seems to be a level. Get above all-time high, momentum traders come in, we get to 120, people will just start chipping away. Once we get up to about 150, right, this is where AVIV, the average active investor, is going to be above profit in 2 standard deviations. Once we get to 168, which as you can see, these are starting to move higher. I showed you those models were drifting higher before. 168, overheated, red hot, unlikely to keep going. Now, when I say unlikely, we looked at those histogram plots. Unlikely means less than 5%. Now, that 5% tail is where the most ballistic price action happens. But it doesn't stay there, and it's usually fleeting, and it usually happens on a day when you're out at the park and it rips, and then by the time you get home, it's all over. So having a plan, understanding that 5% of all trading days, it goes higher than that, it's unlikely to stay there. So 168 is about as high as I can confidently say, like, I'm going to be screaming overheated at that point in time. Let me zoom out so you can actually see it, because there's going to be bulls in the room who are like, check, you're a bear, what's wrong with you? There is a top model here. If you really want to be just hyper bull and just let the market do its thing, that usually we get to 2.4 times the Mayer multiple. So this is as far as I can stretch it. I can't push it higher than that. 220K would be 2.4 times the 200-day moving average. We topped out there in every previous cycle. We've hit it. I don't know if we get there on the first go. Maybe we do. Maybe it takes a little bit of time for the market to digest and actually reach that zone. We'll have to wait and see. So look, we'll see if we do get up to 2.4 times 200-day. By the time we get there, who knows where the 200-day is going to be. But for the time being, the more conservative, check the analyst. 120, selling's going to start. 150, we're getting pretty steamy. 168, it's red hot. And maybe we get a wick. Maybe it's a super cycle. Maybe it's a new paradigm. TBC. 200. I'd be surprised if we get there on the first go. Maybe we've got to chop around for a while and then it will, we'll get there eventually. But, that's a $4 trillion asset. I mean, gold ripped $4 trillion this year. So, we'll see. Now, given we can't predict the future, those tools are going to help us plan. And this is the last chart, because I know it's been a long video. This one, if you've been around the newsletter for a while, you'll recognize this funky, weird looking thing. I'm not going to go over all the details. We will revisit this chart down the road, because this is really where I look at pretty much every single concept we just looked at and many more. I'm looking for just like a broad overview of stuff that might look like a top. So let me just bring in some of our previous topping formations. Basically, I've got a whole series of metrics here. They're color coded. So these are on-chain activity, pricing models, unrealized profit and loss, sell pressure, and losses, realized losses. Now I've just overlaid, and I've actually got to add a couple more, being our recent top, 2019, 2021, and the 2024 ETF top. These red zones, and the denser it is, the more likely, the more points we see there. It's really showing you what does a top look like. At a top, we usually have a fair amount of on-chain activity. Not actually all-time highs though. You can actually see it at tops. We actually usually don't have that much on-chain activity. And notice that the chain's really quiet right now. The chain is actually surprisingly quiet, I'll be honest. In terms of price models, they all start to get to the upper bound. Most of ours are kicking off the fourth quarter. So we haven't quite got up into this topping zone just yet. On the unrealized profit, similar story. We're in the, kicking off the last quarter, but I expect it to move much higher and get up into this zone. So I expect these to go higher. Feels about right. Sell pressure in orange and green, again, quite modest, can go much higher. You can see we get a much bigger bulge. This is where all that sell pressure, profit taking, coin day destruction, losses, we expect there to be very few losses in a bull market. So we're kind of there in terms of losses, but they're not as relevant because when you're near all-time high, there's no one to be in loss. So we will revisit this model as we get closer to conditions that I think are getting towards the top. We can obviously see it on the bottom as well. So you can actually see that bottom formation, we get prices are at the low side, unrealized losses are horrible, profits are small, and losses just explode out the top. Thankfully, we don't need any of those just yet. So that's it, folks. Look, generally speaking, I find it very, very hard to be a bear. I think the market's quiet and trending, stair-stepping higher. The price chart is just absolutely beautiful. It looks like we want to go higher, and the hodlers are saying, I want it to go higher. Can we go lower? Of course we can. If we don't get enough demand, then maybe the hodlers just lose confidence. But at the same time, even if we do pull back, first support, short-term holder cost basis, until we break below that level, I just have to be a bull. I allow myself to be a bull. That keeps me on the right side of the trade. If we break below it, we'll flip around and we'll start looking at why we might be there and assess from that point onwards. Until that point, folks, hopefully you enjoyed that. If you've got any questions, let me know, and have a good weekend. Cheers.